Hi, and thank you for joining Making Waves on Purpose. Today, I'm joined by Olivia Albrecht of Aspiration. This is a carbon finance, carbon credit company. And given there's so much confusion and or discussion, conflict around carbon credits, I think these conversations are absolutely critical to understand exactly what we're talking about. I'm a believer that if we're going to hold companies to the high standard of Scope 3 emissions, we've got to give them every tool in the toolbox. But carbon credits and offsets have to be reliable and verifiable and additional and over a long time frame. It's a tricky business, but it is exploding. I saw Meta just bought nearly 7 million carbon credits from Aspiration. And if you look at the LinkedIn feed of the conversation after that, it's questions like, do carbon credits actually do anything to reduce emissions? And can you please say where these credits will be sourced from? And it's a very contentious space. And I think this is a smart person doing important work in the space. And I think you'll learn something from this conversation. She brings a wealth of experience as well as a really interesting point of view into this conversation and space. So without any further ado, I bring you Olivia. Olivia, thanks for joining us today.
Awesome to be here. Thanks so much for having me, Jeff.
Yeah, great. Well, tell us about your background and what's going on over at Aspiration.
Happy to. So I'm Olivia Albrecht. I'm the CEO of Aspiration, a leader in climate finance. My background was really in traditional asset management. I spent a decade over at PIMCO, a large $2 trillion asset manager in Southern California, a stint of time also over at TCW, a $250 billion asset manager based in LA, building ESG investment platforms. I quickly realized through that experience that there were incredible opportunities that large asset managers couldn't capitalize on yet for a variety of different reasons. And I was looking for an opportunity to join a pure play in sustainable finance and felt like Aspiration was the right platform to build into this new market of the voluntary carbon marketplace. So took the leap of faith to leave the confines of a traditional multi-decade historied company and move over to an earlier stage company to help build out the voluntary carbon markets and lean into this new asset class.
Well, I love that. And I love because I'm a believer that change is fairly retail oftentimes. And the most effective change agents are ones who understand the vernacular and are trusted within that space. So I think, a lot of these voluntary market carbon offset plays are led by people like me who come from a background in corporate responsibility, ESG. And having somebody with your background, I think, is really powerful. And so congrats. And I'm glad you're doing it. So tell me, what are your products and services? What are you all offering?
Well, let me just pull on the thread that you offered in terms of maybe what I'll loosely call recovering finance professionals kind of entering the carbon markets. I think this is really powerful and very important to create a maturity and evolution of the carbon markets to its next stage, which is at Aspiration, we are bringing together what we like to call the superpowers across a variety of different disciplines and areas of expertise to bring together a company of recovering financial professionals, recovering M&A bankers, recovering lawyers, and bringing them together into one house to focus their superpowers in areas of expertise to lend themselves into this new asset class to accelerate and scale the growth of this really critical asset. So it is really important for our perspective. I thank you for your kind comments about me shifting over and changing my career to focus into this space. But this is a deliberate decision at the company, and we are looking to hire folks from big law firms who've had experience with commodities, perhaps even the oil and gas industry or the renewable industry. We are looking to hire M&A bankers who've had experience of the past 10 and 15 years in the renewable energy space as an analog to what could be and what should be created in terms of infrastructure for the carbon markets. And we are looking to do that in a very thoughtful and deliberate way, because while this is a new and growing asset, it is analogous to many other existing assets within the commodity space. And we need to use that lens and that infrastructure to help mature the market and accelerate it into the scale and scope and quality that we all collectively as humans need it to be.
I love that. I mean, you mentioned taking some of the lessons and instruments out of the commodity space, but how are we going to differentiate what are essentially commoditized offerings? How can we differentiate them based on scale or price, or more importantly, quality, additionality, or permanence, or what have you? Can you talk a little bit about that?
It's hard, but it's not impossible. And many asset classes have gone through a similar differentiation. I think of the voluntary carbon markets as a matrix. Across the horizontal, you have different asset types within the VCM space, the voluntary carbon market space. So you can have agroforestry, you can have blue carbon credits, you can have nature-based removals, you can have DAC, direct air capture, you can have a variety of different types. So that kind of spreads you across the horizontal. And that says these assets, while within one giant industry classification of the VCM market, these are very different assets within it. And that makes intuitive sense to me. Then across the vertical, you're going to have features like vintages. So what vintage is that asset coming from? Because different vintages are treated differently due to the methodologies evolutions that you're seeing at the registries. You also see project developer, and different project developers have different reputations in terms of their quality. You have different geographies. Buyers of these assets may be looking for specific geographies, which could bid up the prices of certain geographic types. And it may be more expensive to operate in certain jurisdictions versus others, which may also drive up the price of that asset because the cost basis is higher. So you've got this kind of horizontal cut as it relates to the asset type, and you've got the vertical cuts related to these other characteristics which impact pricing. And where your matrix is building toward, or what your matrix is building toward, is a pricing model. And that makes a lot of sense to me. I come from the bond marketplace, and I could build a similar matrix for investment grade corporate credit. There's different sectors within the investment grade corporate credit space. There's different geographies and different countries with investment grade corporate credits. There are different vintage years or issuance years that a corporate issuer made, and there are specific corporate entities that drive prices in different directions. So for me, that's how I kind of understand the marketplace. That's how I would use a mental map to understand why there are pricing differences in the marketplace today, and how there is a reflection of quality embedded in the pricing that we see in today's marketplace and into the forward curves as well. I see also an analog also to the public markets with respect to credit rating agencies. Rating agencies, whether it's B0 or Silvera, are identical in terms of the model as you would see with S&P and Fitch and Moody's. And that makes good sense to me. We should have rating agencies in the VCM space. That will help create transparency and efficiency and information sharing within what has historically been recognized as somewhat opaque space, where there hasn't been as much information as potentially needed to kind of get it to the next level in terms of these assets being seen as securities. So I think these are all good evolutions in the marketplace. I think we'll continue to see them. And I think it's really critical that we all start speaking similar languages so that we can iterate on why there are pricing differences for one security or for one of these assets versus another.
So how do you talk to company leaders about how to bring in offsets into the company's climate strategy, especially ones that are kind of running scared now? They saw the John Oliver piece or the Guardian expose, both of which, as I talk to friends in the space, they kind of go back and forth between either misguided or cynical in their critique of those two kind of takedowns. But how do you help corporate leaders think this through?
Humbly and carefully, I think, is how you talk with corporate leaders. I think that we have to recognize that carbon credits are not a get out of jail free card for corporations. It's not a utility, or it's not an asset that allows you to continue your operations the same way that you've continued them for the past 30 years. It is a tool to recognize that no matter how well-intentioned a company is, they cannot operate with carbon neutrality today. They have residual carbon liabilities. No matter how hard you try, no matter how much money you pump to this space, you still will operate with some carbon liability. And so therefore, what could or should a company do to address the residual liability? Number one, you could do nothing. Number two, you could do potentially something and invest in carbon assets to help mitigate that carbon liability as you work really, really hard to organically decarbonize your business. So the first way that we talk with industry leaders in this space is to recognize this is not a get out of jail free card. It is a tool to add to a broader decarbonization strategy, which hopefully over time, though not particularly likely in the near term, you would be able to organically decarbonize your business so much so that there is no residual carbon and carbon assets aren't as necessary as they are today. And I think that's the kind of long-term conversation. Additionally, I think increasingly we are seeing from large corporations not only a desire to, at the corporate level, seek to neutralize any carbon liability with these carbon assets, but they are also seeking to engage their consumers with goods and services that are also amplified as being carbon neutral. Whether that's selling a piece of merchandise, a shirt that automatically offsets the carbon emissions associated with having created that organic cotton t-shirt, or for the package that I receive from a company to automatically offset the emissions associated with the delivery of that package. All sorts of different innovative ways of embedding carbon assets into the customer and consumer's experience with goods and services is increasingly a way to differentiate your brand and products versus competitors in the space. And I think that's starting to gain a lot of traction, even so much so as banking partners looking to have carbon neutral products or carbon neutral transactions. So each time I swipe a card, that it's automatically offsetting the transaction that I've completed. That is the innovation that I think folks are looking for to differentiate versus competitors in the space. And then lastly, just to round out in threes, I think that there are several very powerful pioneers in this space who are large Fortune 100 companies who are looking to do more than just simply buy carbon offsets. They are also proactively looking to invest in projects to help create that impact, that environmental and community and societal impact upfront, not just being a buyer of the assets, which is important, but also putting capital at risk and investing in these projects to help accelerate environmental impacts and local community impacts. So those would be the three ways in which we're communicating humbly and carefully with corporate clients.
I love that. I mean, I've always been a believer that if we're going to expect companies to take full responsibility for their scope 3 emissions, we have to give them every tool in the toolbox. And one of those is offsets. But I understand the pushback that, hey, these are, and to your point, they're not a get out of jail free card. So I'd say the good is that, hey, listen, we have these assets available to you that can move you to neutrality today. But what we don't want to send is a message that there's no need to do anything more than that. And I think you're right to point out companies that have put like carbon tax pricing in internal carbon taxes in place, that then they use that money to go out, and some of it will go to buying assets like this. But to your point, some will go into projects on reduction or projects elsewhere to help build out. And my hope is, and tell me if I'm wrong on this, my hope is that the more people who jump into the space and start buying these assets, the price goes up, the quality hopefully goes up, and therefore the incentive to go reduce goes up, because now they're paying more real money for these assets. Whereas 5-6 years ago, maybe it was $1 a ton or $5 a ton or $10 a ton. If we get to $50 or $100 a ton, now we're talking. People are going to start to pay attention.
I think that's absolutely accurate. I mean, I go back to kind of first principles, and there's a incredible supply and demand imbalance that's embedded in this market that's really exciting from our perspective as investors in these assets and as fellow travelers to help mature this business or mature this industry. And so you look ahead and you can do some simple calculations with all of the net zero commitments that have been made by companies, by countries, by municipalities, by states, by whomever. By 2030, there needs to be about 6 to 7 billion tons of carbon credits to meet the demands of these net zero commitments, whereas we are currently generating about 300 million tons per year of carbon assets. So it's a huge delta. And maybe some of these net zero commitments fall away because people who signed up to them maybe didn't realize how expensive and how much it would cost to get there. So maybe some of the demand fades away. But even if some of the demand fades away, you are still looking at an incredible supply-demand mismatch. So there's a concept of the supply-demand mismatch, which should obviously drive prices higher if you think about that basic Econ 101 graphic that's in our head. But what you also need to see is concurrently high quality assets coming to the market. It's not just any assets. What we're seeing in the marketplace today is there's a huge price difference between high quality carbon removal projects versus older vintages, lower quality carbon avoidance in many instances projects. And so I think you're going to also see a really significant price differentiation between these quality assets, which are going to have that price continuing to push higher, and some of the lower quality assets, which I think may over time have a hard time finding a buyer for, in which case those prices could continue to see pretty significant downward pressure.
So tell me what's carbon removal and what's carbon avoidance projects. Tell me just briefly, like examples of those.
Sure. So carbon removal would be planting trees that have long longevity and permanence that wouldn't have been planted otherwise that remove carbon from the atmosphere. Carbon avoidance would be local municipality, had a coal-fired plant in place in town, and we opted instead to create a solar-powered plant. And so we avoided the carbon emissions associated with the coal plant that we shut down. That didn't take anything out of the atmosphere, it just said, well, we expected to run that coal plant for 20 more years and we didn't. So therefore, we avoided 20 years worth of carbon coming from a coal plant. And instead, we put solar.
Right. Which, to your point, I mean, ultimately, nature needs it removed. We need the molecules out of the atmosphere.
We probably need both, right? So there's a place for both of them. It's just when we think about what the science-based target initiatives and some of these net zero commitments that large companies are making, there is a bias toward requiring carbon removals as the asset to mitigate the carbon liability for companies if they want to claim to be net zero. So there's guidance from industry bodies that carbon removals are going to be the assets that can be used to claim net zero, whereas the avoidance credits likely wouldn't be allowed for those purposes.
I think that makes a lot of sense. And I think we're going to see this heat up because the SBTI rules are such that you can say, hey, I'm running towards net zero by 2030. And you're obviously going to reduce less in a 2030 goal than you are a 2040 goal. And therefore, you're going to have to buy your way out more. And you can call it net zero in 2030. But I think by the time we get to 2030, nobody will call that net zero. And they'll have to reset their goals out to 2040 or 2050 to be more in line with the reductions that we really want to see before the offsets come into play. But I love this. I'm sobered by this idea that we've got 300 million tons and we've got to get to 6 to 7 billion. So if I did the math right there, it's 20 to 30x of what we have. That's no small feat. But hopefully, as prices go up, more money flows into the space, more innovation will follow. And I think it's nice, too, you mentioned geographies, that this might be a way for the developing world to get some investment in their activities in this space that have long been on the part of the climate discussions at the multi-international level as to how to make that fair given the West and the developed world has done so much of the emitting to date.
This is part of the reason why I get so excited about this asset class, which is it has shades and similarities to industrialized commodity products. So that's interesting to kind of see the analogy to or the similarities to commodities. It is also interesting because it has shades and similarities to the renewable energy space, which has seen just an incredible tear in terms of market developments and price impacts over the past 10 to 15 years. And then it also has these incredible shades of economic development, where a lot of the projects that we are looking to invest in are very similar to projects that I would imagine the World Bank and the IMF and other development institutions evaluate for the environmental and societal and community benefits from an economic development perspective. And then you have to put on your policy hat, and you have to put on your hat that says what is appropriate and good for these local communities to help encourage additional reforestation of deforested areas, to help support the development of education for women and young children, what is good and important to help alleviate air quality related illnesses associated with open fire cooking and going and grabbing logs and woods from forest areas to cook on throughout the day. And that involves cook stoves and other efficient tools to help ensure that you're getting higher quality health in some of these areas. And all of a sudden, this asset class has so many incredible dimensions that that's, to me, what makes this so exciting. And that's, again, maybe pulling it back to aspiration and how we've thought about configuring our team. That's why we think it's so powerful, important to bring together these superpowers across so many different experts and industry areas, whether it's lawyers or financial professionals or folks who have done economic development from a World Bank perspective, or scientists and horticulturalists and biologists who really understand species and nature from a science perspective. And recently we've been hiring experts. One woman we just hired from NASA, who's a geospatial expert who understands how to utilize satellite and technology to better understand what is happening on the ground in a real-time basis from use of satellite imagery. So again, like, this asset is so diverse. It has so many different dimensions to it. That is what gets me personally so excited about it. And that's why it's so critical for us as a company to design our team such that we're all kind of bringing together our superpowers, all bringing our areas of expertise and background to help mature this marketplace, to accelerate the growth of the market, and to allow this market to scale in the way that we all need to see it.
Totally agree. And I'm glad you're doing that work. So thanks so much for joining us and for all you're doing. And we could go for another half an hour, I'm sure. So we'll have to have you back at some point.
Thank you so much, Jeff. We'll look forward to that next session.
All right. All the best.
Thank you.